Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, or regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Joe Tigay, managing partner at Equity Armor Investments, as well as Mike Khouw, CNBC contributor and chief strategist at OpenInterest.Pro. We're here to discuss why the economic landscape in 2024 presents a fascinating mix of opportunities and challenges, drawing parallels to periods like 1995 and 2007. Both of these years were pivotal in shaping modern economic theories and practices, offering valuable lessons that resonate even today. So, Joe, let's get a quick lesson here from 1995. What resonates from there that you can apply to 2024's economic and market environment?
Yeah, so we had a fiscal monetary policy going from tight to softening, strong stocks growth for the previous few years, which continued, of course. We had strong GDP growth. So it's a lot of similarities from then to today. Of course, that was just the very start of the dot-com era. Maybe it was kind of the tail end of the personal computing era, which had a big rise, and the market couldn't really comprehend yet what was coming in the second half of the decade. Maybe that's something that we're going to be seeing now. We have this AI thing out there. We're not sure exactly what that's going to lead to, but we're really excited about the possibilities.
And Mike, if you flash forward about 12 years later and you take a look at 2007, what parallels can you draw from there?
Well, I think one of the things that we obviously have is, the parallels that I see, a lot of consumer borrowing. We had that, and I recognize that the things I'm going to say here is that it's, while it's important to look at things like employment is often a lagging indicator. We can't really extrapolate a whole lot from taking a look at what the employment numbers were last month or over the last quarter, because the employment picture tends to change very rapidly. A couple of reasons for that. One of the things is that there might be some hold off that management is looking to see what happens. But there's another thing too, which is that at larger companies, very frequently what you're going to see is that companies are essentially looking for permission, if you will, if they're even contemplating reducing their headcounts. If other companies start to reduce their headcounts, it can actually sort of create, a little bit of a waterfall effect where others will say, okay, well, they just announced 5,000 layoffs and we're going to do the same. And we saw a little bit of that earlier this year already. So that's the first thing I would say. The other parallel is that, when we think about risk assets, when we think about equity markets, almost every major equity downturn is propelled in one way or another by a credit event of some kind. And credit events are typically propelled by excess borrowing. And we have a lot of debt. Now, the debt, of course, is a little bit different this time. We're not talking about liar's loans and second mortgages the way we were in 2007. But we have government borrowing that's really quite extraordinary. If you compare, our level of debt, essentially, so we have debt to GDP well over 100%, deficit to GDP at about 4%. This is pretty remarkable numbers, and it's considerably higher than it was in, say, 1995 or 2007, for that matter. In fact, 1995 was the precursor, and we should point this out. This was the Clinton administration. Don't forget that due to pay-to-play rules, essentially, where Congress had said you have to figure out a way for any spending you want to do, you have to figure out some form of tax to pay for it. Don't forget, this was an era when they were still talking about a balanced budget amendment. So there were at least two congressional rules at the time that signed W. Bush, but we ended up actually having a balanced budget at the tail end of the 90s. And it's hard to imagine we could be any further from that now. So, I kind of am likening it to 2007, where we are in right now, more than 95, simply because I don't see an easy way out of that debt crisis that we have. $1.2 trillion deficit, similar, that's again 4% of GDP with 3.2% GDP growth. So where's that growth coming from? It's borrowed money, unfortunately, much as it was in 2007.
Which is so interesting, Mike. And you actually answered the question I was going to ask you, where you see more similarities, whether it's 1995 or 2007. I agree with you with 2007 in terms of the fiscal and borrowing/credit situation that we're in right now. But Joe, you can also kind of make the argument that when we're looking at AI, and you had alluded to this before, that the way we were excited about internet technology feels the way we're excited about AI and the next iteration of how technology is going to transform our lives. I would say 1995 compares to 2024 in that way.
Yeah, sure. In 1995, we had a lot of people buying Dell computers, a lot of big wave of people coming into this next revolution, and that really paved the way for the dot-com eras for that second half. So right now we have a lot of people buying these NVIDIA chips. They're getting ready for this AI revolution. There's going to be some software coming around. We haven't really seen that materialize in any meaningful way that's going to turn into real big revenues. Maybe a couple companies here and there, Palantir, an interesting one people talk about. But for the big companies like Apple, Microsoft, how is that software going to turn on? Microsoft, of course, they got the cloud. They're going to win either way. But I think I'm likening it to, Mike makes a great point that this could look like 2007. And for me, it's just going to be about the economic data. If we can bring up this chart that we have up here, there's, we're at kind of at a crossroads. It could be 95. It could be 2007. It's going to come down to, does the economy hold up? I think either way, though, you're going to see volatility on the rise. So we have this uncertainty over the interest rate policy. We're going to see volatility on the rise. We saw that in 95. We saw that in 2007. Of course, you're probably saying, well, hey, that's probably just coincidence. If the economy does soften, yes, you're going to see volatility rise. But actually, if you look at here, this is what volatility does when the yield curve steepens. So this is the yield curve going from flat to positive. This is the short end of the curve coming down compared to the back end of the curve. And you might think that's stimulative, that means growth, but that actually also adds to volatility. Every time we see this happen, we see volatility on the rise, we see volatility trending higher in either scenario. So for me, I think that's what we need to be looking at. Maybe it'll be dependent on the growth of the economy. Can we be strong? Final point, Mike brings up that deficit spending. Yes, that might be a problem. I kind of see that as a down the road problem, though. That might be a benefit for next year, that deficit spending. We did not have that deficit spending in 95 or 07. Really got to go back to the 40s to see this kind of deficit spending. This probably is stimulative. Is it going to add to inflation? My guess is yes, but for the short term, I don't see the government fixing it, and the short term, this might be good for the economy.
Right. Longer term and figuring out how we're going to pay that back is a little bit difficult of a pill to swallow. But I'm glad you brought up the yield curve here for a moment. And Mike, you're always great with these anecdotal lessons here. The uninversion of the yield curve. We never got into that recession or anything remotely close to it. We're talking about the inversion of it. And now it's becoming uninverted, if you will. Should we take notice to that then?
Yeah, it's interesting. The inversion of the yield curve as a recession indicator, it precipitates a recession. And oftentimes the recession itself and or the financial market stress that accompanies it actually happens during the steepening phase. So, we're looking at the inverted yield curve saying, you get an inverted yield curve, a recession is coming. When does it come and when do you usually feel the pain? Generally speaking, when it reverses. And there's a logic to this, if you can imagine. Now, maybe the Fed isn't behind the curve, basically, literally the rate curve in this case. The reason that happens is because policymakers are doing essentially what Milton Friedman described as, the fool in the shower. It's too cold, so you turn the heat up, and then it gets too hot, and you're basically whipsawing. You're always behind because the person sitting there turning the knobs doesn't recognize that there's some lag between the inputs that you get and the output that you get in terms of the water temperature. And the same thing is often true for policymakers. So the idea is that by the time they start lowering rates, and lowering rates steepens in two ways, because it's stimulative and it's inflationary, therefore the back end of the curve will rise. And of course, they are actually manipulating the rates at the short end. So that's the net impact. So in theory, if you happen to believe somebody like Elizabeth Warren, and I'm not suggesting that Elizabeth Warren, by the way, should have anything to do with what goes on with policies on the rate side, but there have been a lot of people who've been screaming that rates should have been lowered sooner. And the idea was that they saw that inflation the pace of inflation was declining. They also saw that things might be slowing and moderating a little bit. And so they're anticipating what's around the corner and suggesting that a rate change should happen sooner. So that's the logic for why you don't actually start to see the recession until you actually get the steepening and the yield curve normalizes. It's because the policy actually was lagging, and now it's trying to respond to that. So the flip side of this is that whether or not we get a recession is going to be controlled not only by that, but it's also, and consumer confidence and things like this, but it's also going to be controlled, as Joe was pointing out, high deficit spending is stimulative. Is it a healthy form of stimulation? Well, not necessarily. Government investment doesn't typically pay the same dividends. You're probably looking at about 65 to 70 cents on the dollar relative to private sector investment. But when you look at the normalizing in the yield curve and people are saying, oh, see, we got the soft landing. Well, I would caution people that maybe they're being premature by suggesting that, because that remains to be seen.
Right. Let's talk about the divergence in performance relative to the indexes. If you're looking at the S&P 100 versus the S&P 500, and even, relative to the Nasdaq, why we're seeing divergences of performance at this point, Mike, is it because the market is broadening out and we're seeing rotation into other sectors here?
Well, we definitely are seeing some rotation into other sectors. I mean, the market was largely propelled by a very, very narrow group of stocks, and with good reason. I mean, one of the things about the Mag 7, for all the knocks that one might have about it, is that you're talking in many cases about pioneering technology, huge cash flow generation, very solid growth, growing. The things I like to look for in businesses are massive free cash flow. They had all of that. Growth that exceeds the greater of inflation or GDP growth as a minimum, but hopefully they have growth that exceeds that of the S&P generally. So S&P earnings grow on average about 6-7% a year, about 2 times GDP. And the largest companies were growing at rates that were low double digits, in some cases much more than low double digits. If you're looking at a company like NVIDIA, where you're seeing, triple digit growth year on year. But that's not sustainable. You get to the law of large numbers. That's certainly the case for NVIDIA. And also valuations started to price that in a little bit more. And I think, that's one of the reasons why we saw money flowing into some of these other names. And that does make a lot of sense. One of the things I would also say, we're talking about S&P 100, we're talking about the, mega cap stocks, really, even outside of the Mag 7. And that is, so we got a significant bid even to, what we'll call small cap stocks. So like the Russell 2000, particularly after the first presidential debate. And why would that be? That made some sense when you think about it, because that elevated Donald Trump's chances at the time. And I think he is viewed, regardless of what one's political views are, I think it would be safe to say that small business viewed his policies more favorably as being, essentially stimulative for them. And so that would help explain why you would start to see that kind of action. And actually, it's interesting because the relative performance of the smaller cap companies and those that are more capital dependent on borrowing, they've actually, that performance, relative performance, has correlated pretty closely with Donald Trump's polling numbers. So they improved right after that first debate, and then they started to sell off a little bit as Kamala Harris came on the scene and started polling maybe better than some people expected she would.
Yeah, well, it's interesting because I feel like the small caps, certainly over the past number of years, they kind of get off the starting line and then they just peter out. There hasn't been like a prolonged trajectory there, at least at this point in time. But Joe, I want to get your opinion and outlook here in terms of why you're seeing the divergence, and do you see that continuing to widen out, breadth widening out? Is it really dependent till we get past November? What are your thoughts, sir? I mean, for all intents and purposes, we're going to be in Q4 pretty soon.
Yeah, and that's a great point on the small caps versus probability of Donald Trump being president. I had not thought about that, but that seems spot on to me. If you want to look at this chart real quickly, just so everyone can see what we're talking about, this is In orange, we have the S&P 100, the OEX. If you're a former CBOE floor trader, that's what we called it. Middle black line is the S&P 500, and the Nasdaq is the blue line on the bottom. So yeah, we're having the S&P 100 doing the best this year. Have to take it with a grain of salt, though. We need to remember the Nasdaq was the best performer last year, so there is some catching up to do. Mike hit it on the head. A lot of the gains came from the Mag 7. Some of those Mag 7 names are struggling this year compared to the rest of the market. But if you look at the S&P 100, which of course is just doing a lot better than the Nasdaq 100, you're seeing some of the big performers from companies like Costco, companies like Walmart, 3M. So we're getting some really good performances from some of the retails, from some of the consumer. That actually seems like a positive sign for the economy. We have not seen a slowdown in those big names, especially Walmart recently, Costco recently. I think there's still juice left in the American consumer. Has me going back to the first block, the A block, has me leading more towards 95, saying, hey, there's still some more potential upside in this market.
Yeah, well, I mean, Joe, too, when you think about the S&P 100, that also includes financials, right? And we've seen that rotation into financials, which could also explain perhaps why it's outperforming as of late, the Nasdaq 100, right? Because we don't have financials in that index. So that's another way to express this rotation that we're seeing. Let's get a little bit more stock specific here and talk about Micron. Earnings are coming up. We know that it's within one of the key sectors that's been driving not only growth in the economy, but certainly has lended to stock market performance as well.
Yeah, it should be a fun event. We have earnings coming up. Usually we see about a 6% implied move or a 6% move. We're actually getting a 9% market maker move. The market makers are pricing in 9%. A lot of open interest on the 100 strike in Micron. People are really, really betting on a huge upside blowout earnings following this event.
Yeah. So, Mike, when you think about Micron's earnings, and it seemed as if the entire marketplace, with the exception of rate cuts, was focused on NVIDIA, right? When that company had reported numbers, do you expect that same amount of either apprehension, excitement going into Micron's numbers? From a fundamental perspective, where does it sit relative to NVIDIA? Is it similar in businesses? How do you think investors are going to approach this?
Yeah, it's not similar. Theirs is a much more commoditized business. NVIDIA essentially owns that whole GPU space. I don't know whether the rumors were true about, all of those big honchos, including Elon Musk and Ellison and Gates, all these people sitting down with Jensen, pleading for GPUs. But, the demand and the pricing there is very, very different. I mean, you're talking about 80% gross margins for NVIDIA, whereas Micron, being more commoditized, they actually have, over the course of the last several years, seen profitable years, but also unprofitable ones, because, if you're in a commoditized product space, then, you're going to have to contend with competition. There is one thing that Joe mentioned that I would like to go back to, though, also reporting earnings next week, by the way, and that's Costco. And Costco's not implying a very big move. I think full week implied move is about 4.4%. 1 day implied move is probably in the mid threes. And that's arguably because Costco doesn't typically move that much on earnings. But there is one thing that concerns me, and that is that, they've had 10+%, maybe 10.7% compound annual growth rate to earnings over the course of now a couple of decades. If you take a look at the earnings for Costco, it's a beautiful thing to watch. It's just basically lower left to upper right. The problem, though, and the reason that Costco shares have done so exceptionally well recently, is that a lot of that outperformance has been coming from multiple expansion. This thing is trading 50 times forward earnings. Now, what's the right multiple for Costco? A lot of people will sit there and tell you, look, it always trades at a premium. That's true. It has historically traded at a premium to the S&P, to its peers, and for good reason. They get subscription revenues because people are members. And, they seem to be resilient during economic times, good and bad, because maybe people actually make the effort to go to Costco when they're being more cost conscious. But 50 times earnings and 10% compound annual growth rates are not really compatible over time. So we're going to need to see something really exceptional from them, I think, to justify that. And if folks are looking for a trade, if you own it, which who could blame you? I have something called the Holly Index, and I always take a look at, what shows up on the credit card receipts, and whatever shows up a lot, I figured that's what's in demand, because how would I know? I don't shop for anything. My kids and my wife do. And so Costco always appeared on my Holly Index, along with Tesla and Apple and actually Nike. But I think those multiples are really hard to justify right here and now. And for anybody who's an XLP, it's 14% of the Staples index right now. So that's also a risk, I would say.
Yeah, it's funny. Every time I see Lulu, I always think of the Holly Index as well, because I remember you equating that stock to her shopping habits, which I can certainly relate to. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.